Hey everyone, Couch Investor back to another video for today. So it's earnings season, and as always, I like to start off with Netflix. Now at the time of making this video, the stock is down 26%. If you thought this would be an easier earnings season, well, guess again. It's down 26% basically because it lost subscribers for the first time in over a decade. But there's much more to the story than just this headline. So we'll discuss all of that in this video. Obviously, during the earnings season, I'm gonna make more videos than usual because we cover a lot of companies on this channel. Now, Netflix. So they reported earnings per share of $3.53 versus the consensus of $2.90, which, okay, they beat on that. Revenue came in a bit short, $7.87 billion versus an estimated $7.93 billion. And now comes the big bang, the big hit on the company, and that's the net paid ads. So global streaming paid net additions were negative 200,000 in Q1 versus an expected 2.5 million. But if we go and look at their shareholders letter, you can see that they're writing here. Paid net additions were negative 200,000 compared against their forecast of 2.5 million and 4 million in the same quarter 1 year ago. Obviously 1 year ago, still COVID, etc. But still, it's a big miss. Now, the suspension of their service in Russia and winding down of all Russian paid memberships resulted in a 700,000 negative impact on paid net ads. Excluding this impact, paid net additions totaled positive 500,000. Now, fine, it's positive now, but they still expected 2.5 million. So if you take the exclusion of Russia, then it's still a miss of 2 million, which is still a big deal. They continue by saying that the main challenge for membership growth is continued soft acquisition across all regions. Retention was also slightly lower relative to their guidance forecast, although it remains at a very healthy level, they believe among the best in the industry. Recent price changes are largely tracking in line with their expectations and remain significantly revenue positive. Now, and as for guidance, they expect earnings per share for Q2 of $3 versus an estimated $3.01, so in line, let's say, and revenue of $8.05 billion versus an estimated of $8.21 billion. Now, the company sees Q2 global streaming paid net additions of negative 2 million versus the consensus of adding 2.4 million. So not only did they lose, when we exclude Russia in this quarter, 2 million, they expect to lose another 2 million in the next quarter. Yes, granted seasonality, etc., it's always a weak quarter or so, but again, losing 2 million subscribers and then losing another 2 million is a bit worrying. But it doesn't stop there. We have a lot more to talk about: sports, advertising, gaming, content, etc. But first, I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. All right, so first up, I'm gonna switch it up a bit because I think that during the call, they gave us much better information than what's written actually in the shareholders letter. But there is one graph I would like to show you, and that's this one right here. Share of total US TV time. This is May 2021. You see Netflix is the red one, 6%, total 26%. Now fast forward February 2022, it grew to 28.6%, and Netflix share grew to 6.4%. If you look at YouTube, 5.7%, Hulu stayed flat, Prime Video grew a little bit, Disney Plus grew quite nicely, 0.7%, then all the others grew 1.5%. So yes, maybe the market is already saturated for Netflix, but then again, there is a growing streaming market. And now to touch on the important points they mentioned during the earnings call. The first one being the sharing of accounts. They've been working on a couple of things, and you're gonna see why it's very important, because they say here that another focus is how to best monetize sharing. The 100 million plus households using another household's account, which if you think of it, is a pretty big deal, because if they can monetize this base right here, it will obviously boost their revenue. Now they've been trying out a couple of things. If you have a subscription, you can just pay a little bit more and then you can share this account outside of your household. This was actually announced in March, paying to share Netflix outside your household. Basically, they're trying it out in Chile, Costa Rica, and Peru. So what basically happens here, you can add an extra member to your membership at a much lower price. You can transfer profiles to a new account as well. Now, it's not about removing existing users, because everybody that's sharing their account like the service, right? Otherwise, you wouldn't use Netflix. It's about how to monetize the people that already like the service they're getting, but not scaring them away by charging them a bit too much. So maybe adding, if you want, you have your account at home and then let's say your sister or your brother doesn't live with you anymore, just pay $2, $2.50 extra and they can use it outside the household. How will this take effect in real life in huge markets like the United States, Canada, Europe, UK? Remains to be seen. Right now they're testing it out in smaller markets, but when this will work out, this will obviously boost revenue for the company. Second thing they mentioned during the earnings call is obviously content. Content is power. If you don't have good content, well, people are more likely to churn, because nowadays you have a lot of choice when it comes to streaming. So they have to invest in content. Now, how do you do that if you cannot monetize all your users correctly? It's an issue. That's why they're working very hard on the first part we mentioned. Now, something else is the fact that some of the content on Netflix has become a bit too woke, let's say, and that might again also make the content unwatchable and scare people away. Maybe not scare people away, but incentivize them to just cancel and go away. We've seen what happens now with Disney, with all their political agenda, etc. Might be happening to Netflix as well. Who knows? But again, content is extremely important. Yes, in some quarters you will have better TV shows and better movies than in some other quarters, which goes into the next 2 points, which is gaming and then possibly sports. Sports was actually the last point basically that they mentioned during the earnings call, and that's with the fact that they had huge success with Drives to Survive, which is F1. It has also accelerated the growth of that sports viewership worldwide. So it was asked, do you think about going into sports in the later stages? Right now, they prefer to stay in content. With tennis, they're going to add tennis, a bit the same like Drive to Survive, golf as well, and see where that leads. With gaming right now, they're still in their own lane. They're acquiring smaller companies that might help them build better games, but that's about it. Which is leading me to the last and most important points, and that's the fact that they are now very much considering adding an advertising side of the business. Now, I know already a lot of people are writing in the comments, oh, I don't want to see ads on Netflix, and that's fine. You don't see ads on Netflix right now, right? You can stay with that account. But if you're not willing to pay $13, $12, $14 or so, I don't know how much Netflix is costing right now, you can just have the ad-supported model. You will pay less, which means they can attract way more subscribers. They can attract more revenue streams because, well, advertising in the digital age, connected TVs, digital ads, etc. is growing, as we've seen with the Trade Desk and Roku. And Netflix entering that market will obviously be a huge boost for the likes of Roku and the Trade Desk, because the CEO said during the call that they do not want to have all that huge work in the background with regards to advertising, targeting, etc. They'll go to a company that does everything that should be done behind the scenes, let's say. So the likes of the Trade Desk and Roku, they just want to focus on the best experience that they can offer to the viewers. Then if there is an advertising side of the business, all of that should be done with one of those companies, Trade Desk, Roku, Magnite, etc. Now, I'm for an advertising model because, well, one, it's cheaper, and two, it brings more revenue to the company. Also, it's not going to be advertising that is not relevant to you. It's going to be targeted advertising and very, very seamless advertising. It's probably not going to cut in the middle of the movie. Amazon Prime, for example, has their own advertising at the start of a TV show, at the start of the movie, maybe promoting their own TV show, their own movie that's coming up. Could be something like that. Could be maybe shoppable content as well. We've seen Roku and Shopify do that. So the sky is really the limit here. Now, all of that is not going to happen very, very soon. It's probably going to take a year or two until it gets implemented and tested. Now, they're not going to test it in smaller markets first and then see if they want to do it or not. Because they said during the call, they look at Hulu, they look at Disney, HBO, etc. They seen that the advertising model works, so they don't really have to test it out. They just need to see how smooth the transition will be and how they can still offer the best experience to their users. So, overall, to conclude this video, a bit longer than expected, but hey, maybe a bit more information as well. Should you be worried as a Netflix shareholder? Obviously, if they keep losing 2 million each and every quarter and you don't really see the light at the end of the tunnel, then yes, you should be worried. But seeing that they're now willing to pivot to add an ad-supported side of the business, to me, is very, very reassuring because it's something that we know that is working for others. Very, very easy to do. You're going to attract more subscribers, more revenue, so why not? So overall, right now, pretty neutral. I do have Netflix on the channel's portfolio on stockcard.io. I plan on adding more shares today because 26% hit on that quarter is a bit too much in my opinion. But then again, could get worse, right? So to conclude, pretty neutral on that front. We're going to see what happens in the coming quarters and the coming years. Now, if you're a shareholder, do let me know down in the comments below what you thought about this quarter, guidance, and the possible adding of advertising on Netflix. Let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And as always, guys, take care, stay safe, and see you all in the next video. Bye bye.